At University of Pennsylvania's Wharton School of Business, Jeremy Siegel. Professor Siegel, let's talk a little bit just about what we saw with inflation last week. That CPI number that we got on Thursday was hotter than expected. We've seen a lot of things that have kind of come through, and it has people thinking that the Fed is going to keep rates higher for longer. I know you've been an advocate of kind of slowing down, having them stop to see what's happening, but this weekend, Bullard from St. Louis, the Federal Reserve Bank of St. Louis president, said that he could very easily see, or kept the door open for 75 basis point hikes both in November and December. If that happens, what do you think happens to the economy?
Well, Becky, that core rate looked very bad, but let me tell you that it is not an accurate look at the core rate of inflation. Let me tell you why. 40% of the core rate of the CPI is shelter and housing. So let me give you a couple statistics that show you. The way it's constructed is so lagged that it way understated in 2021, way overstating what we have right now. Since March 2020, when the pandemic began, until this summer, the Case-Shiller housing index was up 40%. The Zillow and apartment list rental index was up 30%. Guess what the CPI shelter index was up? Only 11, because of the lagged way that they constructed. So this is interesting. Jason Furman, great economist. I think he's one of the CNBC contributors, and he's been on your show quite a bit. He decided last week, he said, well, what happens if we put a current rental, like Zillow rental, into the CPI index? And he tweeted this late last week, and the results were really shocking. What you got was that core inflation on a 3-month annualized basis, and this is a measure that Jay Powell has looked at, reached 16% in 2021. About double what the official number was. And by the way, it was in the first half of 2021 when the Fed said there's no inflation problem at all. Now, what's the bottom line? It way understated the inflation we had. We've had much more inflation. And now, when house prices are going down, when rental rates are going down, and I don't mean they aren't jumping from where they were a year ago, but not as high as they were now. If you take a look at these indices, we should have had a negative number there instead of a positive. And what that means, the way they constructed is we're going to get 0.7, 0.6 plus 0.8 for month after month after month. In 40% of the core, it's going to look horrible. Oh my God, the Fed isn't succeeding. We have to keep on hiking rate, when it is giving a totally distorted view of the actual on-the-ground rate of inflation. I think that the Fed has to rethink about using current data, and they will see that their policy has worked and inflation is down, and those core statistics are not giving an accurate representation.
Hey, Jeremy, it's interesting that you bring up Jason Furman, though, because he definitely comes from the Larry Summers camp that says the Fed needs to keep raising rates. They thought the Fed started too late, just like you did, but they are in the camp that the Fed needs to be super aggressive, that once inflation has worked its way into the wages, as it has, that it's a much stickier thing and much harder to kill.
Well, I know that Jason has made that. I'm wondering whether some of his recent research might have him think, my goodness, forward. In fact, he intimated that when he tweeted it. This might mean that forward-looking inflation is much less than what we actually fear. I mean, I'd like to hear Jason on that because I think now certainly there's a lot of inflation in the pipeline. There's no question about it. And I think you've got to let that go through the pipeline instead of just beating these non what we call market responders, like medical inflation and all that. That's going to go through the system going forward. If you try to beat that down, and by the way, you mentioned a good point about wages. Wages are not going up as much as inflation. That Thursday number, and it wasn't really reported much, the same time we got the CPI number, we got that wages have fallen 3.5% behind inflation year over year. It's hard for me to think that that's going to be a big cause of pushing inflation when the wage earner is falling behind inflation. And I think putting the burden now saying, oh my goodness, we got to crush the wage earner and stop him from or her from getting wages to try to catch up to all the inflation that we've already experienced.
But wait a second. If you had wages that were keeping pace with inflation, we'd be in a world of hurt right now. I mean, it's not that you want to crush the wage earner. You want to crush inflation. Some other things may happen along the way.
Yeah, but what we're saying, should we permanently harm? He and she has fallen 3.5%. And that was the statistic.
I know, but that's not a reflection of wages as much as a reflection of inflation.
If you want them to fall further behind inflation, because inflation is going to be in that pipeline, they've actually fallen much further behind inflation.
It's a conflation to say that it's wages that's the problem here. The problem, because wages have been higher, it's just they haven't kept pace with inflation because inflation has been so out of control.
Yeah, I know, but what I'm saying is the actual rate of, I believe it should be -0.7 in shelter. If you put that in, core inflation is near zero right now. Actual rate of inflation.
So wages are keeping up better than anticipated too.
And now it's a wage catch up to that particular point. Let those wage catch up. I think the forward and something else that's really important. Everyone said the Fed's its policy is not working. Well, listen, we know monetary policy takes 12 to 18 months. They exploded the money supply in 2020. Did we get inflation in 2020? No. We began getting in 2021. The Fed didn't recognize it, not until much later. And when did they start tightening? In March. All right. So we've had 6 months of tightening. And do we expect that already to appear in the core rate of inflation? No. But if, just like the explosion of the money supply did not appear in 2020, it's going to take time. I think that the amount of tightening, I think getting up into the high 4s or 5, as Larry Summers has suggested, is far too high and will definitely risk a much stronger slowdown than we need. Right now, the money supply, as I've mentioned, has shrunk since March. This is unprecedented over a 6-month period. 5% a year is consistent with 2% inflation. If they keep on tightening, they're going to push the money supply down, and that's going to cause, I think, a too severe reaction. And they've got to recognize that the shelter prices are just not current prices, and they're a big part of the core.
Jeremy, what are the real implications? Let's just game this out. If they go ahead and raise 150 basis points in the next 2 months, what does that do? Because you think they've already risen too much, and you expect a downturn.
No, I think that I would call for 50 now and then a stop, and I wouldn't even mind a stop, because I think if they wait, they will see how inflation's come down. Everything that's sensitive and the goods prices has come. I could say another 5. I worry about this idea that we're going to stay in the high 4s as Fed funds futures, as Powell, higher for longer. That worries me the most. I think they're going to have to bring the rate down a lot during 2023. And I think the talk of that's what's scaring the market, higher for longer, because the market does see these higher rates are going to pinch, and they're pinching the interest sensitive parts of our economy already. I think we're going to have the second biggest housing price decline of post-World War II period over the next 12 months. And that's a very, very significant factor for wealth, for equity, and the housing market. So I think that they've got to slow down and wait and see what the tightening has already wrought on the economy.
Let's just talk about this idea that the markets, equity markets and beyond, are watching to see for the Fed pivot. They're anticipating that there's going to be a point where they say we're not raising rates anymore. It's not just that we're going to stop and look around. From here on out, we're either going to remain flat or start to take rates down. And what the Fed chief has wanted, what Jay Powell has wanted, is to slow down some of the excess in markets all over the place. Probably very happy with what he's seen to this point in terms of slowing things down, letting some of the air out. If the market senses anything as any pause as a pivot and then reflates, that's probably not an outcome they'd like to see. I know it's a behavioral psychology sort of question, but that's what you're dealing with markets.
Jay Powell or the Fed hasn't acknowledged the progress that is made, that they've slowed down all commodity prices sinking, freight cargo rates sinking, most importantly, housing prices sinking. I mean, they seem to be oblivious to that. And now they're saying, well, wages are going up when they're trying to catch up. And core inflation, which is the very last to react, is still going up. I mean, it's sort of like, a tin ear. Why don't they acknowledge the progress that they're making? Are they a fear? It is psychological. They so underrated what inflation was happening over the past 2 years. They're going to say, oh my goodness, all right, well, I'm just going to stand firm against it. I'm not going to let any light through and crush it at all costs. And that's not the right solution, in my opinion.
All right, let's just talk about how volatile the market's been. You're looking at up 351 for the Dow futures this morning. We saw some big swings last week. Even though we got that hotter CPI number on Thursday, the markets ended sharply higher, up like 800 points or something after being down 400 or 500 points. You saw on Friday a reversal of that. The NASDAQ was down 3% on Friday. Just these big swings we're getting on a regular basis. This is as the market's trying to figure out what's coming next, what to make of all of it. Jeremy, what would you tell people to do right now if we're watching on the Fed and so much is reliant on that, but you're somebody who long term is always positive about just what happens to markets? Over time, they go up.
Right. Well, I think we're 20% undervalued from where we should be. Now, does that mean that tomorrow or next week it's going to get there? No, we know that. And there may be more downside if Powell keeps on talking tough and doesn't recognize the progress. Certainly there may be downside, but my feeling is that the long-term prospects look excellent. I mean, the reason why, I think Mike Santoli said, hey, you know what? The market has been remarkably stable given all the bad news, and look at the earnings. The earnings are not coming down that much. Now we're just beginning to be in earnings season, and yet look at the decline, 35% for NASDAQ, 25% for S&P, just about matches a recession coming up. And that's not absolutely certain. I mean, it would be if they stayed at 4.5% for all that next year. My feeling is they're going to begin to see that slow down, first in the labor market, jobless claims, the JOLTS data, which went down quite a bit last month. See if we're going to continue when we get the next report there. And then they're going to ease off. I think that, the market's looking for any hint that the Fed sees that they have made progress. And then I think that the rally from these lows will be very strong.
Professor Siegel, thank you. We'll see you again soon.
Thank you, Becky.
Coming up, Jim Cramer's first take on the trading day ahead. We're going to play you part of my conversation with Pfizer CEO Albert Bourla, speaking out for the first time since having COVID twice in 2 months. We're going to discuss the implications of that, as well as how people are thinking about boosters, Paxlovid, and more. Stay tuned. You're watching Squawk on CNBC. We are live at the NASDAQ market site.